Continuing our series for Warren Buffett's 4 rules for investing in any stock, we have today's episode with his second rule. Warren Buffett's second rule of investment is long-term prospects for the company. Theoretically, he hopes to hold the company forever, but realistically, you have to imagine holding the company for at least 10 years for your calculations. For 10-year prospects, let's have some simple thought experiments on 4 different business models. Number 1 is a salt mining company. Looking 10 years in the future, I think everyone can agree that there is a reasonably strong bet that it can still operate and be growing 10 years from now in the future. Number 2 is a company that only develops games on smartphones. Looking 10 years in the future, it's really unknown how companies like these will do. After all, they rely on using a different company's platform in order to make profits. And if the smartphone fades out of popularity, or if the smartphone company wants a bigger cut for using its platform, the game makers could suffer. Number 3 is any multi-level marketing or MLM. For those unaware of MLM structured businesses, the majority of the profits comes from recruiting more and more people rather than selling the actual product. Looking 10 years into the future, a dark picture for these companies is if people stop getting recruited or legislation gets passed to view them and treat them the same way as pyramid schemes. And number 4 is a drink distribution company. 10 years in the future, it's very likely people will want bottled and canned beverages, so this seems like a very safe bet for the future. Now the question might come up, why care about long-term prospects? Because after all, can't we just invest in Amazon, and then after a couple months, switch it to Tesla, and then transfer all that money, and invest in Apple, and then transfer all that money to McDonald's, and so on through Visa and through the Coca-Cola. It doesn't seem to make much sense on the surface why we have to care about holding something for more than 1 year if we can just move our money so quickly and easily with stocks from one company to another. After all, in theory, if you had an investment with $100 and then after holding it for a month it became $110 and you decided to transfer that into a different stock, and then that stock went up by $10 and you decided to transfer it into a different stock, in theory, it seems like you made 30% return. The issue with this theory has to come down to taxes, because the IRS sees that you made a lot of money and you sold stock, and it wants some of it. And here's the difference between the two. Assuming you're filing with the short-term capital gains tax and you're having about $40,000 as a single person, your filing status is about 22% for that bracket. However, if you were the long-term capital gains taxes, and again you're single and your filing status would now, for the same $40,000, be only 15%. And that certainly seems like a pretty great return difference. However, when you see those scam ads online that say, make more money on your investments with this one easy trick, I don't think they're talking about the difference between short-term and long-term capital gains taxes. Another benefit of holding long-term is that you only tax when the investment is sold, excluding the dividends. So let's say you bought $1,000 of Amazon, and it was bought in 2019, and it was sold later in 2050, and it rose to $10,000. Then that would mean that the gains that you got on that, the $9,000, only gets taxed once at the 15% bracket. However, if you had $1,000 of Amazon and you buy it in 2019 and then sell it before the year 2020, and then you did the same thing in the year 2020 and sold it before 2021, and you continue until the year 2050, it gets taxed each year at the short-term rate. It's worth mentioning that taxes on investments are typically a big target during elections and can change as the years go by. Although the percentages and the bracket numbers can change over time as the years go, the tax reduction for holding investments long-term has remained the same. So to answer the question about why care about the long-term prospects and why is this one of Warren Buffett's 4 rules for investing in any stock, it's primarily because of taxes. So if you want to hold companies like Coca-Cola, Visa, or McDonald's, and you buy them in 2019, the best case scenario is that you're able to hold them for the long term and then sell them years later in retirement when you need the cash for income and you only get taxed once at the long-term capital gains rate tax. And that concludes rule number 2 for Warren Buffett's 4 rules for investing in any stock. So once again, if you're new here, subscribe and hit the bell for notifications to get updates on this series and other series that I'll be doing in the future. And like the video if you enjoyed it so that others can see it as well. Thank you so much for watching, and I hope to see you in the next episode.